To that point, just in terms of the higher inflationary regime, that's obviously had an impact on Treasury yields. We're headed for a historic 3 consecutive year of losses. We're in uncharted territory when it comes to that. What will be the impact of this rethink on the bond market?
We're also in a different regime with regards to bond market investing. So the ballast of bonds in portfolios has been more challenged, as we have seen last year, as we have seen this year. But income is finally back in bonds. So far this year, the temptation is to look at what's happening in markets through our equity lens. But equities have been very, very concentrated if you look at the U.S. equity market. So really, we believe we should be looking at market dynamics through a rate repricing lens. And so far this year, 10s has moved up by 75 basis points. A large part of that was started early on in the year through cash path repricing. So markets kind of waking up to central banks are going to have to stay higher for longer in this world shaped by supply. But more recently, we also had term premia coming back. Term premia has been deeply negative for a very long time. But in the context of higher bond volatility, in the context of QE giving way to QT, in the context of fiscal imbalance and greater issuance, term premia has more to go, and which is why we have been underweight U.S. long duration for a while, and we continue to be underweight.